Okay, so today we're going to tackle a major contradiction that's playing out in the financial markets right now. I mean, on one hand, you've got the experts acting supremely confident, but on the other hand, there is a record-breaking pile of cash just sitting on the sidelines. So what does this paradox really signal for the future? Let's dive in.
But first, let me ask you something, just to frame this. Right now, what's your play? Are you waiting for things to pull back a bit, keeping your powder dry with a lot of cash? Or are you totally all in, maybe even leveraged up, just riding the momentum? Where you stand puts you on one side of this massive puzzle.
And here's the first piece of that puzzle. A recent survey found that professional fund managers are holding just 3.9% in cash. I mean, that is getting pretty close to a record low. This is the so-called smart money, right? And they are almost fully invested. That suggests a huge amount of confidence in where the market is headed.
But then you've got this, the total amount of cash in the U.S. financial system, what economists call the M2 money supply, is holding steady above a record $22 trillion. That is just an unprecedented amount of liquidity sitting out there.
So, how can both of these things possibly be true at the same time, right? How can the pros be all in while the entire system is just flooded with cash? And, more importantly, what does this whole setup mean for you, for the markets, and for what happens next? That's what we're going to break down.
So let's start by trying to decode what the smart money is actually telling us. Because when we look back at the history of these fund manager cash levels, a very, very clear pattern starts to emerge.
Looking at this timeline, a really fascinating pattern just jumps right out. It turns out that spikes in cash holdings, the times when fund managers got scared and sold, have been incredibly reliable signals of a market bottom. Just look at these dates. December 2008, right near the financial crisis low. April 2020, which absolutely pinpointed the COVID crash bottom. And October 2022, marking the end of that year's bear market. Time and time again, when the pros get fearful and they pile into cash, it's actually been a fantastic time to buy.
So here's the key takeaway on this. High cash levels are a fantastic contrarian buy signal. But does that mean low cash levels, like we have today, are a sell signal? Well, the data says, not really, no. If you look back, low cash levels in 2004, 2013, and even early 2021 all happened in the middle of major bull runs, not at the top. So while today's low cash might mean some of the easy money has been made, it's historically been a pretty unreliable predictor of a market crash.
Okay, so that kind of explains the fund managers. But what about that $22 trillion? To understand that, we need to bust one of the biggest, most common myths about how the stock market actually works. You hear people say it all the time, right? I'm putting my money into the market. But that's not really what happens. Money doesn't get absorbed by stocks or Bitcoin or real estate. It's really just a transfer.
Let's just walk through a super simple transaction to see how this works. Okay, so you, the buyer, you have dollars. The seller has a share of some company. You give your dollars to the seller, and they give you their share. The asset has changed hands, sure, but the dollars haven't disappeared. They've just moved from your bank account to theirs. The total number of dollars in the system is completely unchanged. So the rise and fall of the market has zero effect on the total money supply.
So if buying and selling assets doesn't create or destroy money, what does? Well, this brings us to the real engine of our entire financial system, debt.
You see, in our modern fiat currency system, new dollars are literally loaned into existence. When a bank makes a loan, it creates new money. And when debt gets paid off, that money actually disappears. In the past, this created these natural economic booms and busts. But today, policymakers hate contractions. So whenever the system is at risk of money disappearing, they step in to make sure it gets replaced with new, cheaper money.
And we might be getting very close to one of those moments right now. Delinquency rates, that's just people failing to make their payments, they're on the rise pretty much across the board. Credit card delinquencies are up. Student loan delinquencies have absolutely skyrocketed now that payments have resumed. And auto loans are seeing more defaults too. People are really starting to feel the strain of these higher interest rates.
And this isn't just a household problem, not at all. Corporate debt is at an all-time high. And
Of course, the U.S. national debt has now crossed $37 trillion. Everyone, from families to corporations to the government itself, is just saturated with debt that needs to be rolled over. So this all leads us to the final piece of the puzzle, and a major twist that I think most people are not expecting. We're all waiting for the Federal Reserve to start cutting interest rates to give us some relief. But what if those cuts actually make things more expensive for you?
It's the big question, right? When the Fed finally cuts rates, is that going to make your mortgage, your car loan, your credit card cheaper? The simple and kind of shocking answer is probably not.
We actually saw a real-world example of this not too long ago. As the market started to anticipate that the Fed was going to cut rates, something really strange happened. Even as the effective Fed funds rate started dropping, the 10-year Treasury yield, which is what influences mortgage rates, it did the exact opposite. It shot up from 3.6% to 4.8%. Long-term rates went up, not down. So, why?
Okay, here's the causal chain. See, the Fed only controls overnight rates, the really short-term stuff. So when they cut, it makes it cheaper for the government to borrow short-term money. And what does the government always do when its borrowing costs go down? It spends more. That spending is funded by more borrowing, which, as we just learned, creates new dollars. More dollars chasing the same amount of goods leads to inflation. And when long-term lenders, like your mortgage provider, expect higher inflation in the future, they demand higher interest rates today to protect their purchasing power.
And that brings us right to the central paradox of this whole thing. The Fed's attempt to make money cheaper for the government could actually trigger a chain reaction that makes long-term money, like your mortgage, even more expensive.
And that leaves us with a pretty provocative final question. If the go-to solution for economic trouble, just cutting interest rates, now has the potential to make life more expensive for everyday people, what does that mean for the future? What tools do policymakers actually have left in the toolbox? It's a paradox that's definitely worth thinking about.